Why you should never invest in dividend mutual funds. That's our topic for discussion today in the Market Secrets investment series. Before we get started with the today's session, I'd like to mention that we at Market Secrets had recently launched Algo Traders program ATP. If you are someone who is interested in learning end-to-end algo trading, then you can consider joining our ATP program. I'll leave the link to it in the description section of this video. And with that note, let's jump into today's session on why you should never invest in dividend mutual funds. Dividend mutual funds are now renamed to IDCW. IDCW is income distribution come capital withdrawal. So this is the new name for the dividend mutual funds. The dividend option in a mutual fund is now known as IDCW. Okay, so the dividend part is now renamed as IDCW. In this option, dividends are declared periodically from the gains made by the mutual fund, and it is paid out to the investors as dividends at pre-decided intervals. So the dividend payout frequency can be daily, monthly, quarterly, or annually. So when you invest in a mutual fund, if you are selecting this IDCW option, that is the previous dividend option or the current IDCW option, you'll be asked to select frequencies in which you want to receive dividends. So you can select either daily, weekly, monthly, quarterly, or annually. So it's up to you. Based on that, the mutual fund will give you dividends. But you need to know that there is no such thing as dividends in mutual funds. The so-called dividends from mutual funds serve no purpose. They are not like the dividends paid out by the stocks. Dividends from mutual funds are artificial and misleading marketing tools. That is why SEBI actually asked it to be renamed to IDCW. In case if you have opted for this dividend option of a fund or IDCW option of a fund, you are almost certainly paying needless taxes. That's what you need to understand. You are paying unnecessary taxes. Let's understand how. When it comes to dividend paid by mutual funds, the dividends is nothing but part of profits or the money made by the particular mutual fund. The mutual fund scheme is simply distributing the profits among the investors in the form of dividends. And when it distributes the profit, the NAV comes down by the same extent, clearly showing that you have taken money out of your investments. That's what you need to understand. It's not a free money. They're just taking part of your corpus and paying it out as a dividend. For instance, you own 1000 units in a mutual fund with an NAV of rupees 20. Your investment value is worth 20,000 rupees in this case. 1000 units and each unit has NAV of 20, so 20,000 rupees worth. The fund announces a dividend, that is IDCW, of 20% of the face value, which is rupees 10. So face value of almost all the funds are rupees 10. So 20% of face value of 10 will be 2 rupees. Okay, so the payout amount will be 2 rupees per unit. Since you are holding 1000 unit, you will receive a dividend amount of 2000 rupees from this mutual fund. However, you should note that this amount will come straight from the value of your investment. So on the record date of this dividend payout, the NAV of your mutual fund will drop by the same 2 rupees. So it will drop from 20 rupees to 18 rupees. This means that along with receiving the 2000 rupees as dividend or IDCW, your investment value will be worth 2000 rupees less. So your investment value will go down to 18,000 rupees as well. This is the reason NAV of the dividend scheme falls by the extent of the dividend paid to the investors. So this is not a free money. They are taking part of your corpus out and they are paying it in the name of dividends or IDCW. Dividends or IDCW in mutual funds are taxable at the hands of the unit holder based on the income tax slab rate applicable to them. So you'll have to pay taxes on your slab rate. In case you fall under 30% tax bracket, you will have to pay tax at 30% on the IDCW amount regardless of how long you have been investing in that fund. This robs you of the tax efficiency that funds otherwise offer, and this exhibits a disadvantage the IDCW option carries for the investors. So you're losing all the tax efficiency and you will be paying unnecessary taxes. In case if you opt for growth option of the same fund and hold it for more than a year, the first 1 lakh return from the fund will be fully exempt from the tax, and any profits beyond that will be taxed at 10% under LTCG. So your returns from growth option of the same fund will be tax free for the first 1 lakh, and post that it will be 10% tax. But if you opt for dividend or IDCW option of the same fund, you'll be paying taxes at 30% of the IDCW amount. And now it's not just 30% tax on the returns. It is, it's more complicated than that. So let's come to that. Okay. If you opt for IDCW option, you have to pay tax on the entire IDCW or the dividend amount which you receive from your mutual fund, which includes both income and capital components. Yes, you heard it right. You will be paying tax even though capital is being returned by the mutual fund. For example, right, you choose weekly payout and you are investing in Nifty 50 IDCW mutual fund. Okay, it can be any Nifty 50 fund. Okay, any fund house. You are investing in the IDCW option. Okay, and you are choosing the weekly payout. Okay, so this fund has to pay dividends weekly compulsorily. Okay, so if you select weekly, it should have to pay dividends weekly. Okay, so imagine the Nifty goes down for 6 months from the date of your investment. So it goes completely down for the next 6 months the moment you invest. Okay, this is just an example, okay, to help you understand what kind of taxes you are paying. Okay, so you might think it might go up. Even if it goes up, it's going to be same. But imagine that Nifty is going down for 6 straight months from the date of your investment. And even in such case, the fund will have to continue to provide dividends for you every week. Okay, because you selected the weekly dividend option, so funds should have to pay out. Okay, so in this case, where will the money come from? It didn't generate any profits from the moment you invested, right? It's Nifty is going down, so it's already in losses, but still it has to pay you the dividend. What the fund will do, it will simply return your capital. And even though it's returning the capital, I mean, even though it's just transferring the capital that you have invested, right? Since this capital is being paid out in the form of dividends, right? You have to add this to your income and pay taxes at the slab rate on this dividend. How does that sound? Crazy, right? Yes, that's how it works. That's why we should avoid this dividend or IDCW option blindly, because you are investing money which you earned post taxes, and you are investing it in some mutual fund, but accidentally you have selected this dividend or IDCW option, and even though that investment is also in the loss, since it's a dividend payout, fund house is paying you some amount of dividend from your capital, and again you are paying taxes on this capital return. How tax inefficient this is! It is very, very crazy. Okay, so if you are understanding what I'm saying, you will know how stupid this sounds. Okay, that's why you should never go for this dividend or IDCW option. It would make more sense to opt for growth option of the same fund and let the capital gains alone be taxed. And remember that too, for the first 1 lakh, every year you can claim exception. So it's madness to ignore that. But in case if you want a periodic payout, right, there is an alternative, and that is also a simple alternative, right? There's a systematic withdrawal plans, SWPs. SIPs are systematic investment plan. Likewise, if you want to periodically withdraw money, there is systematic withdrawal plans, SWPs, by which investor can specify a certain amount that is to be withdrawn automatically every month, and it should be credited to their bank accounts. So if you want regular payouts, you can opt for SWPs instead of going for this dividend mutual funds. And with that, we have come to end of today's episode. If you have any queries, comments, or feedback about this episode, leave it down in the comment section. I'll be happy to address it. Also, hit the like button if you like this video and share it with your friends if you find it useful. Also, subscribe to our YouTube channel and click the bell icon to get notified whenever we upload a new video or conduct a live session. Thanks for watching. Have a great day. Goodbye.